Welcome to The Explainer. Today, we are completely demystifying a massive, real-world passive income strategy. If you've ever found yourself wondering what a multi-million-dollar portfolio actually operates like under the hood, especially one built almost entirely on high-yield, covered call ETFs, well, you're in the right place. We're going to unpack the exact mechanics, the inevitable mistakes, and the unique mindset it takes to operate at this level. So let's just jump right in. $2.4 million. That is the sheer scale of the total portfolio value we're talking about today. But it's not just sitting in one giant pile. It's actually strategically spread out across three specific buckets: a primary tax-free savings account, a spouse's tax-free savings account, and a non-registered cash account. Managing something of this size takes a level of organizational discipline that really goes way beyond just picking the right stocks. But honestly, the overall portfolio value isn't even the most impressive part. $50,000, that is the amount of passive income this setup is generating every single month. We're talking roughly $600,000 a year in sheer cash flow produced entirely by distributions. Just think about that level of monthly cash injection. Getting there requires a very specific type of investment vehicle, which, as you know, means accepting certain trade-offs that we're going to explore. To make sense of all this, we'll navigate through 5 key areas today. First, the $2.4 million portfolio. Second, the core and satellite strategy. Third, the tax efficiency debacle. Fourth, deploying $120K in July. And finally, capital versus total returns.
Section 1. The $2.4 million portfolio. When you're managing millions and generating high yields, where you place your accounts is just as critical as what you're actually buying. This multi-layered structure, splitting the funds across a primary TFSA, a spouse's TFSA, and a cash account, is really the vital groundwork that supports all this massive income. You see, the investor is trying to optimize their tax implications, and because they're non-resident of Canada, they face some very unique withholding taxes. So knowing exactly which asset lives in which account is absolutely crucial, because if you get this wrong, well, it's an incredibly expensive headache.
Section 2. Core and Satellite Strategy.
A key takeaway here is how this portfolio completely avoids becoming a chaotic alphabet soup of random tickers. The assets are trunked into 3 highly deliberate buckets. First up, you have the boring anchors like HDIV, HYLD, and QQCL. These do the heavy lifting. They provide that foundational index-based stability. Once that foundation is solid, they layer on the tech and crypto satellites like HBTE, HHIS, and Big E. That's where you get that spicy, concentrated US tech and AI exposure. And lastly, they throw in raw commodity producers through an all-in-one fund called CMCL, which gives leveraged exposure to energy, gold, copper, and uranium. It's structured, it's deliberate, and it serves a massive long-term goal. Now, you might think $50,000 a month is the finish line, right? Incredibly, for this portfolio, it's literally just a milestone. They're systematically scaling those core and satellite positions we just talked about to double their monthly cash flow. The goal is $100,000 a month by June of 2031. Hitting a target like that requires immense discipline and aggressive reinvestment. But as you'd expect, the journey to $100K a month is never perfectly smooth.
Section 3. The tax efficiency debacle.
Let's get into a pretty painful, time-consuming debacle that unfolded recently. The investor decided to sell off an underperforming ETF called PG so they could buy a high-performing split fund called Class A inside their non-registered cash account. Sounds totally logical, right? Well, they miscalculated the tax data. They quickly realized that nearly 50% of Class A's distributions were classified as Canadian-eligible dividends. For a non-resident, that is a complete tax disaster because you don't get the benefit of local tax credits, that money just vanishes. To stop this massive leak, they essentially had to do a frantic reshuffle. They sold Class A out of the cash account, sold a more tax-efficient fund called HDIV out of their TFSA, and completely swapped their locations. And here is the real cost of that mistake. Because they were forced to sell and rebuy assets just to fix the account placement, the whole ordeal accidentally triggered $5,441 in realized capital gains. They essentially had to pay taxes on over $5,000 in profit, all just to save what amounted to a $25 a month tax leak. So while their book cost goes up and they do eliminate that monthly drag, it's just a brutal reminder that one tiny miscalculation on dividend classifications can cause a major headache and waste a ton of time.
Section 4. Deploying $120K in July.
Despite that tax headache, they had a massive amount of capital to put to work in July, fueled by an $80,000 non-resident tax refund plus their standard monthly buys. That's $120,000 total. They leaned incredibly heavily into their stable core and financials, dropping $65,000 into HDIV and Class A. Then $40,000 went into those concentrated tech plays, $25,000 to commodities, and $15,000 into the highly volatile crypto and AI space. Honestly, it's a masterclass in sticking to your target allocations, even when you're deploying a lump sum that most people would consider a lifetime of savings.
Section 5. Capital versus total returns.
It is absolutely essential we juxtapose these two concepts. A lot of folks just open their brokerage app, check out the red or green line of the current stock price compared to what they originally paid, and that's how they judge their investment. That's just the capital return. But when you are investing specifically for passive income, staring at just the stock price means you are entirely missing the massive cash flow happening behind the scenes. Total return is the true metric you want. It means judging the investment by taking your capital gain or loss and adding it together with all the lifetime income that position has pumped directly into your pocket.
The formula is simple but game-changing. Total return equals unrealized capital gain or loss plus total lifetime distributions. When you apply this exact math to high-yield covered call ETFs, it completely flips the narrative on what makes a successful investment. Think about it. If a stock goes down $5 but pays you $10 in dividends, you're still winning. Let's see how this plays out with real numbers from this specific portfolio.
The numbers here prove the concept flawlessly. Take a ticker like HHIS. If you only track the stock price, you'd be panicking because it's down $65,000 in capital value. But when you factor in that it's generated a staggering $200,000 in lifetime income, running the total return formula shows the investor's actually up well over six figures, $135,000 in the green. Same goes for HBTE, down on paper, but up nearly 50 grand in reality. Now, to be totally objective here, this approach doesn't erase risk. Look at MST. It's down so heavily in capital, $243,000, that even its $77,000 of income couldn't save it. It has an actual total return of negative $166,000. Total return simply reveals the true, unvarnished health of your assets.
So this forces us to ask a tough question. Are you judging your investment solely by the stock price, or are you actually accounting for the total return? Managing millions of dollars in ETFs isn't just about blindly chasing yield. It's about structuring accounts, dodging tax traps, aggressively deploying capital, and having the mental fortitude to look right past a red stock chart to see the true cash flow. I hope this deep dive into a $2.4 million portfolio has given you some incredible insights to apply to your own financial strategy. So keep learning, keep analyzing those total returns, and we'll see you on the next explainer.